On this week's episode of the Full Subjects podcast, we are breaking down the latest Fraser Valley Real Estate Board's stats package, telling you what's going on in the market and what is not going on in the market. And I think that would really surprise you. This was a great episode with Alex Dunbar joining us to break down this stats package. We had Alex in for a couple episodes in a row to bulk record a couple episodes as we get into the end of summer here. So thanks for joining us. And great stats package. I think a lot of the information will surprise you. I would consider it actually a pretty positive stats package update, but listen to the episode for more of the details. As always, this podcast is for informational purposes only. It does not constitute any legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. And let's get to it. All right. Welcome back. Another episode, guys. Cool. The stats episode. Let's hop into this. And of course, we have our favorite Alex Dunbar joining us. I don't know any other Alex Dunbars. So Cole, take it away.
Yeah, so as always, guys, we like to do a quick update on what we're seeing from kind of an economic standpoint, how that impacts interest rates, kind of just how that impacts the market overall. So as everyone probably knows by now, we didn't see a rate cut in July, and that was to be expected. No one was really predicting that. But where do we go from here? So unemployment data came in today, actually. It came in, it's still at the same rate, 6.9%. But we lost about 40,000 jobs in July. So
is that good?
It's not necessarily a good thing. I mean, last month we saw over 80,000 jobs increase, so we gained 80,000 jobs last month. This month we lost about half of those, if we look at it that way. So youth aged 15 to 24 saw the biggest employment drop in July, and that was just due to difficult job market in the summer. A lot of that age demographic are looking for part-time work in the summer, and there just wasn't as much available to them. This is kind of interesting. So layoff rate remains steady. So that just means that people aren't getting fired or laid off any more than they were before. It's remained fairly steady, which is a bit surprising given that there's uncertainty with trade, and some industries are seeing more impact because trade is obviously causing things to cost more, and these businesses can't survive, or they can't hire or employ as many people. The Canadian dollar got weaker because of the unemployment news. Not a big shocker there. What I take away from that is spend your money in Canada. Try to continue to shop locally as much as you can. From personal experience, I've seen a lot more people vacationing in Canada this year, especially in the summertime, which I think is great. So inflation numbers for July, they're not out yet. They come out in August. That's going to be a big factor in terms of what's going to happen with the next rate cut. Right now we're seeing about a 40% chance of a rate cut in September, and that's up 30%. That's up from 30% prior to getting the unemployment data today. So makes sense. We lost jobs, better chance of a rate cut. Most people believe that we're going to see a rate cut by the end of 2025 in some capacity. So we've got 3 more to go. When will that happen? We don't know, but there's a lot of belief right now that we're going to see at least one more, and it's likely a quarter point. So last but not least, rates. We did see fixed rates go up a little bit in the last few weeks. Now, bond yields have come down recently, so it's possible that we'll see rates kind of adjust back. Unfortunately, rates tend to go up a lot faster than they come down, so don't necessarily expect that rates are going to drop just as quickly as they rose. But overall, I'd still say rates are kind of sitting where we expect them to be in the long term. I'm not expecting rates to fall below 4%, or if they do, they'll kind of bounce around between the high 3s and the low 4s. I'm expecting that's where fixed rates will kind of sit for the next little while, but we'll see some ups and downs kind of just as the market adjusts to things that are happening like unemployment. So yeah, that's it for the update on the market right now in terms of the economic portion of it.
Yeah. So Alex, when you hear some of that stuff, what comes to mind for you? Talking about unemployment numbers. I know we were joking about in a group chat that we have that Daniel Folk, I believe is how you pronounce his last name. He had posted, Folk. He had posted a visual. So and I had restoried it, but unemployment rate reached its highest level since 2010 per StatCan, kind of contributing to some of those unemployment numbers. Like, what does all that mean to you?
It's always an interesting one because, and maybe Cole can speak more on this, is like, what exactly do they consider jobs, and like how are those numbers potentially being manipulated? Like, You know, if you're an Uber driver, like does that count towards it? If all these other like kind of subcategories potentially, or people with multiple jobs, is that looked at like if someone has 2 jobs and they go to one, is that a job loss because they're still employed? So that side of it's kind of interesting to me. But I mean, just looking at the numbers that we do have, uh, I think everyone has been expecting at least another cut or two potentially by the end of the year since earlier. Obviously, that's kind of changed, but I also don't see that making some significant impact in the market. Like another quarter point maybe helps a little bit with sentiment, but I just personally don't see that like making things take off per se. But on the other side of that as well, yeah, it's just with the tariffs and the uncertainty and these things that still haven't really been settled. I think there just still is this level of uncertainty out there, which is kind of holding people back. Plus, we're heading into August, which is typically one of the slower months of the year outside of the winter time, just because people are going back to school or enjoying the rest of their summer. So yeah, I personally don't see anything like major happening in the next little while. It seems like, I mean, I guess you'll probably get to it, sales data and stuff, but looking maybe a little bit more positive at this point. But yeah, I mean, I'm not going to be someone to sit here and pump the market at this time. It does seem like things are looking a little bit better though.
Mm-hmm. Yeah, I like what you said there with, is a quarter point really going to help a bunch? Probably not. I mean, I think, as much as Cole mentioned that fixed rates have went up a little bit, but, bond yields have shifted, so they might be coming down. I think that we're kind of sitting about where we're going to sit for the next little bit, short of them making some small changes with the Bank of Canada announcements. But like you said, like if things drop another quarter point or even a half point, like realistically, that's going to save people, is it $7 or $13 for every 100 grand that they borrow or something like that per month? So like realistically, that's going to save people what, 50, $100 a month, depending on their size of their mortgage. I don't think that that's necessarily going to be a reason that people buy or don't, or are going to make a massive change with people's monthly budget. Just my opinion. So
yeah, I think that like prices have come down, and that's been more of a factor is when we're reaching certain levels. So for instance, like just personal anecdotal example, I've had, let's say a townhome listing under 750 in Cloverdale, Clayton area. Before, the majority of people would be all over this because these were selling in like the high sevens because it would get them into this, maybe not the ideal property, but a great starter home because everything that they wanted was over 800. And now all that stuff's come down under 800. So even the lower price point properties, even though they are better priced than the rest of the market, people are now able to actually buy what they want to. So I think that's why we're seeing a bit of like uptrending sales to some extent, rather than like the very bottom of the market being stuff that people just buy because they solely have to, or that's all they can get. Now they've got the options and it's like, hey, before if I was capped at 700 or 750 or whatever that number may be, all these new options have now kind of come onto the market and give them more things to choose from. So I think now people are actually having the option of like, instead of just being shoved into something that, it works, but it's not ideal, they can now kind of go out and have some options out there.
Very well said.
Yeah. Yeah. And Austin, I was going to say, your math is pretty good on that. Like that number changes a little bit depending on what interest rates are. So as interest rates get lower or higher, that how much you save per 100K is going to adjust a little bit, but that's pretty good estimate in terms of what you can expect to save for every 100 grand. And I think you put it well, like that's not going to encourage people to buy because, oh, wow, I can save an extra $50 a month. It does help the people that are already in a variable rate mortgage or they have a line of credit that they're going to save a little bit of extra interest on. So that's where you're going to see the benefit, but not necessarily from people that are looking to get into the market, I would say.
I think fundamentally the problem is like, like we talked about in the last episode with Braden, like the capital problem. People figuring out, do I want to be spending $3,000 or $4,000 a month on their mortgage to get into the market? I don't think that 39 or 3,900 or $4,000 is can ultimately be the difference of like, well, for 39 I'll buy, but for 4, no. Like that's realistically like that's a DoorDash order or, one expensive dinner out for a couple like a month. I don't think that's going to be, the main factor of why people buy or don't. Just my opinion.
Yeah, absolutely. You guys want to jump into stats?
Let's do it.
All right, so this is our third time I think doing this now. I like to say the headline of the stat package now because it can kind of pave the way for what's going on. So, headline of this stats package for the Fraser Valley was Fraser Valley real estate sales activity levels off as market enters seasonal slowdown. So, I don't know. The way I interpret that is seasonally, you're expecting things to slow down in the summer anyway, which is, I think they're almost saying, well, because of the summer, it's expected that we're going to see real estate slow down, although we were already seeing it slow down going into the summer. So I don't know how much of that's true, but you guys have any thoughts on that before we get into some numbers?
Yeah, I mean, we finally broke 9,000 active listings at one point this year, and that's kind of come down. So I guess it's a factor of both looking at new listings coming to market, which are down, even though sales are pretty much flat. Because of that, it's kind of, the ratio has changed a little bit. So no, it's not like sales are increasing necessarily, but based on the amount of inventory that is now coming to market or has been pulled off, it's making that look a little bit better. So I know they kind of do seasonally adjusted stuff. And as I mentioned, August is usually one of the slower months. And then we get a bit of an uptick potentially in September, October before a bit more of like trending back down as we get into January. But yeah, I guess that's kind of how I see things, which, as I said, a little bit of positivity, but nothing substantial.
What I think is kind of interesting, and obviously we're going to, Alex touched on it, but we're going to dig into like the specific numbers. What I kind of found is a lot of the stuff that was actually sitting on the market finally popped or finally sold. Like, for example, I chatted with Alex about this listing that I had in Cloverdale, and it was sitting. Nothing in this complex was selling. There was like 5, 6, 7, 8 listings in total. And then none of them sold for like 2 or 3 months. And then in the last month, I've seen 4 or 5 of them finally, successfully sell. Yeah, a lot of those numbers, there was a couple price adjustments. There was, moving the goalposts a little bit. Some of them did kind of sell quickly that had popped up in that complex. But yeah, it kind of feels in some ways, some of the listings that were sitting for a while finally found that right buyer and were finally able to be successful.
Yeah,
Did you find that Did you find that as well, Alex, with some of your product, or what have you kind of personally
Not mine.
To everybody else's. Sorry, buddy.
But I think it's a good point to make right here as well, is that, there are a lot of the conversation we're having, like we tell people where market value is, and maybe if they're not in a position where they absolutely have to sell at that point in time, they want to test just a little bit higher, right? Like something that's somewhat reasonable. And unfortunately, some of these, and it's happened to me as well, where we get, it doesn't quite work out in the first 2 weeks. I mean, average days on market's probably closer to 30 anyways. And then as we go to make that price change, all of a sudden, somebody else who is super motivated lists a property in the same complex, a decent chunk below you. And then you're kind of out of luck there, right? Because you wanted to take the chance to, let's just say get an extra $10,000, $20,000 instead of kind of playing at, let's say a safer bet where you're hedging your bets essentially, especially in a somewhat downtrending market. And now all of a sudden, once they sell, like now you might be looking at $40,000, $50,000, $60,000 less, right? So, and it's a tough one. It's every situation's a little bit different, but I think that's a hard one to get through anybody's mind. Like, I think we'll talk to Austin in a bit because he just went through the process, but even being very, analytical about it, there's always the what if, right? There's always the what if, and you feel like maybe we got a full price offer on day one. It's like, oh, well, did we list too low? But I think that's one of the challenges that I've seen out there. And some of the product, like, I think you're right that it is starting to move. And then there's other stuff where, like, not even mine specifically, but speaking to other agents, and it's like, I don't understand why this hasn't moved yet. It's already at a fantastic price. I'm literally calling them wondering if they're trying to like generate multiple offers or something like that. They're like, no, we just want to sell this thing and it's still not moving. It's weird. It's interesting. But yeah, I guess from my perspective, those are some of the things that I'm seeing.
Yeah, that makes very, very well said.
All right. That was great, guys. Let's get into some of those numbers that Alex kind of touched on a little bit already. You kind of gave a little bit of an insight on where we're going with this. So new listings dropped 5% in July. So that's down 5% month over month. Active listings were down 2%. They're still hovering between 10 and 11,000. And then the other interesting part about that is that's 50% lower than the 10-year seasonal average. So, sorry, higher, excuse me, 50% higher than the 10-year seasonal average. So lots of active listings. And I'll jump right into the next side here because Alex kind of touched on it. So sales stayed almost flat. Like it was a 0.5% decrease. So almost no decrease compared to June. So yeah, overall, like we're seeing more sales to listings based on listings coming down a little bit and sales staying relatively flat. But overall, still we're 23% below the 10-year average for sales, and that's only 3% lower than last July. But I mean, I don't think these numbers are a surprise to us. And I think you guys already kind of touched on this. But is there anything else you guys want to add onto listings, sales, any of that sort of stuff?
I guess just quickly, like typically we see sales peak around between April and June. In the number of them, and then as we kind of said, they kind of tinker off to the end of the year. Might be a little uptick towards October. So this is what we would expect. I feel like outside of the whole COVID market, a lot of times from what I've seen, the earlier in the year where sales are peaking, usually those tend to be a little bit stronger years. And I think that's where people get the idea of the spring market, right? Whereas those aren't necessarily, or the trends aren't necessarily following that as of late. So it's, you kind of got to take everything year by year. It's hard to look back and try and equate this year to what happened 10 years ago. It gives you an idea of the trends, but yeah, I mean, everything's just so unique at this point in time.
Yeah, I think what's also interesting too when we're talking about like active listings and then transaction ratio, sales to active, certain pockets. And Sachita from my office did our monthly our bi-weekly market update. And I know you guys obviously can't see that because we're recording this after, but what's really interesting is, we look at the averages and we look at active listings. And obviously there's also a ton of pre-sales right now that are also available and people are trying to sell and flip those. And that doesn't show up on the MLS stats, all that kind of stuff. But like certain pockets are actually like balanced markets and some are even closer to sellers markets, believe it or not. Like Cloverdale, I'm looking at townhouses from the stats, fraservalley.bc.ca stats market. This is something that we have on the back end. I'm looking at sales to active ratio for July of 2025. It was 19.4%. Like, and typically we consider a seller's market 20%. So like that's a really solid market to be moving in if you're a seller thinking about upsizing and you have a townhouse and maybe you're wanting to get into a detached or get into a larger townhome. Like that's as long as you're priced reasonably and you're marketed well, like you're gonna sell. When I'm looking at detached in Cloverdale, again 14.6%, so that's more of a balanced market. And then apartments in Cloverdale last month were 26%. So again, some of those condos that were sitting for a while were finally starting to go. And I guess my point with this, again, just to come full circle, is as much as we look at the whole picture, there's certain pockets that are doing better. And then, of course, that means some pockets are doing worse. And I think we know which those areas are. But anyway, we'll continue on.
So what you're saying, the key is to sell in the areas like that would then have a high sales to active listing ratio and then buy in the ones that are low, and that's where you can find the best deals.
Well, I think I mean it's a great point, but maybe that's a conversation if you're a realtor listening to this and you have some clients that are trying to make the most of the market. Hey, maybe you really want to be in Willoughby for a townhome, but maybe there's a better ratio or a better sales to active ratio in Walnut Grove, and maybe you can save 1% or 2% by going to somewhere that isn't as much in demand if you do have some flexibility. You can use all these stats as leverage when you're presenting your offer and say, hey, look, like, this is what we think market value is. We know that X listing has been sitting for a while. This is what these buyers are willing to pay. And, as long as you're okay with a slightly different postal code, maybe that means that you can save a little bit of money. And these always fluctuate. Alex, I'm sure you remember times where, Walnut Grove was stinking busy and then some parts of the year, for whatever reason, it's just a little bit quiet. And I'm just giving Walnut Grove as an example. I mean, we could pull that up, but maybe that is some ways that you can make the most of the market by maybe having a little bit more flexible criteria to help you get more.
Yeah, I think, and the key point there is just like looking at the situation holistically. Mm-hmm. Which, I mean, I've been talking about this locally recently, but I mean, if you're had people in unfortunately opposing situations where, so for instance, right now, from my understanding, Edmonton is like a crazy hot market.
Yeah.
Parts of Ontario, like Ottawa, apparently is like a pretty hot market as well. And so, I mean, if you were trying to make a move from there to here or vice versa, unfortunately, I had people going the other way, which wasn't a decision that, I mean, they didn't have the choice of like, hey, we want to wait till it's perfect.
Mm.
Whereas like everyone I'm talking to now is like, hey, is it a good time to sell? And it's like, well, it should always be, it really depends. Like, what's your next step? Are you planning to rent for the foreseeable future because you don't know where you're going to end up? Do you know exactly the location and property type? Because we can take a look at those two things. And even if hypothetically, let's say you're moving from a townhome to a detached, maybe your price is 50,000 lower than it was a couple months ago. But if the market that you're moving to, or if that detached property, if those are down 200,000, 10%, whatever that may be, right? Like it might make a lot more sense for you at this point than trying to wait until prices go back up because you want to sell your place for the most amount of money. And I mean, there's
then you're buying for the most amount of money, right?
Yeah, exactly. So just looking at things as a whole and not getting too tied to each side of the process individually, and like they're not mutually exclusive. So that's where I find people get tied up when I'm having conversations like, hey, well, I want this much for my property. It's like, well, why? Right? When we kind of dig down and get to the bottom of it. And I think, the more practical and reasonable you can be with all that stuff, and it's tough. I understand that it's an emotional process and you've lived there and everything else, but there's some good opportunities for certain people, and for others, there's not. I've told, more people than probably almost any other year that like it's probably not best for them to sell at this point in time. So just understanding the situation and being open to, not having like a bias or your mind made up before you have that conversation.
Yeah, you had a great social post about this. I can't remember if it was a reel or a story, but it was basically the HBI price graph, and it was showing like the difference from peak to the market to like now, as an example, and just how much money you kind of save. And again, it's all relative. I think that's a really great way that you've explained it. It's depends on your situation. It depends what you're coming from or going to, and that's why you have people like Alex or myself or Cole giving you advice, because we'll tell you if it's a good time to move or not, and just give you all the information to make an informed decision.
Yeah, and if I just want to touch on that quickly, because what typically happens is the market like it elevates to some extent at a quicker pace than it will, and when it's coming down, it compresses. And what I mean by that is generally, like general trends, it's not always perfect, but if the market's going up, detached typically leads the race, followed by townhomes and condos. And so generally that's both relative and absolute. And what I mean by that, relative is like percentage based, right? So if everything goes up by 10%, the highest is going to go up by the most. However, a lot of times it actually goes up by more relatively and more as an absolute term as well. And just to try and break that down, right? Let's say 500,000 is your condo, 750 is your townhome, $1 million is your detached. I mean, it's more than that, but 10% of each of those, right? It's 50, 75, 100. So you're continually raising that gap. Now, in the other direction where we are right now, you're going to see the same sort of thing, right? Now, if that comes down by 100,000, down by 75, down by 50, you've now shrunk that gap. And again, generally the top of the market is going to compress by even more, and the bottom is going to hold on a little bit better, which shrinks the gap and makes it easier to get into that next property. Now, the one caveat here is if it really depends on the equity that you have as well, because if your equity is shrunk too much, then the opportunity doesn't exist, right? I want to make sure people understand like this doesn't work for everybody. But like if you've lived there for a period of time, and let's say, I don't know, you bought for 300,000, prices went up at one point to 600,000, now they're back down to 500. Like you still got a good amount of equity. But if you just bought recently and you went from, 450 to 550, now you're back down to 475, like there may not be enough equity, but you never know. You just got to have the conversation and see where things are at. So
yeah, no, I think that's really well said, and it's good to put some numbers behind that because you're absolutely right. It's more than just the total cost. It's percentage based, and it's absolute value as well. So I think that's really well said. Let's get into some costs here. So benchmark prices were down 0.7% overall. So they were down, not a huge drop. For your detached, we're looking at about half a percentage point drop month over month. Townhomes were a little over 1%, and then apartments or condos were a little over close to 1.5% month over month. And across the board, all three of those were down between 4 and 5% year over year. So prices are coming down a little bit. That's not, I don't think, a surprise to us. Where do you guys see prices going?
In the near future? But I also don't think there's going to be this like major downturn or anything like that, given we don't have some major like black swan event or something of that nature. Just seems like things are stabilizing. I wouldn't expect any major movement in either direction over the next couple of months personally, but I'll let Austin go first, but I'd like to pass it back to you because the thing I've been hearing about over the past 3 years is this whole mortgage renewal cliff, and I feel like it just keeps getting pushed back a year after year after year. And I'm like, okay, you said it was going to happen last year, now it's going to happen this year, now it's going to happen like the following year. And I don't know, I'll let you speak on that, but from the numbers that I see, I don't know, it feels more sensationalized than it really is.
Go ahead, Austin, and then I'll answer that.
Yeah, I mean, I think similar to Alex, could I see things? I don't see things going up short of like, again, some crazy event. One of the other numbers that I'm looking at here from the Stats Center is like percentage of list price. In Cloverdale, as an example, townhomes were selling at 99% of list price. Apartments were 98%. Detached homes were like 97.5%. So I think we, as realtors and also with the market, I feel like we're more accurately pricing things, which might be, some of the things that actually leads to more sales. And again, it's not 112% like it was in 2022 of what things were selling for. That's a really funny number to look at on the map. I know this isn't necessarily a visual medium if you're listening on podcast, but anyway, a little bit of a tangent there. But yeah, I see things kind of hanging out where they are. Could I see things going down slightly? For sure. I think there's a lot of inventory there, but I think, as you're talking about all of this, like, it depends on how long you're really going to be in your place for. So like, as an example, if you're going to be in your place for 5 years, 8 years, do you care if prices go down another 1%? If you're starting to build up that equity, or like in the short term, not necessarily if prices went down over a 5 or 8 year span, I'd be a little worried. But like, let's say if prices were to go down a little bit and then continue to rise as we've seen historically, I personally am not worried about that as much. It just needs to make sense for your situation.
Yeah, I think that's well said. To answer your question, Alex, it's tricky because I think if I remember correctly, rates were kind of the lowest in probably 2021. Like 2020 is when pandemic started. It took a bit of time for the market to go, oh crap, we're all going to be sitting at home, and not to mention like the Canadian economy it was going to take a hit because the government basically gave it a lot of free money, right? And that's why we saw inflation go to where it was. So I think it took a little bit of time for rates to come down. So 2020 means most people, let me back up a little bit. So most people are taking 5-year rates at the time, or 5-year terms at the time. That's kind of your bread and butter most of the time. I would say that's changed a little bit recently. You're seeing a lot more people choose 3-year right now. And that's really because people are hoping rates will go down in the next 3 years and not be stuck in a higher rate than 5 for 5 years. Is that going to happen? We don't know. But what I wanted to say is I think 2021 was kind of your magic year when rates really went low. And Yeah. And so basically putting that at next year being the big year of renewals coming in at probably 3-ish% higher than what they were dealing with before, right? Now, with that being said, there's a lot of options. Number one, you've paid on a lot of your mortgage. Like for 5 years, if you've been paying 1%, like you're really heavily paying down the principal on your mortgage, which is great. Obviously, this is a 25, 30-year mortgage, so you're not paying it all off in 5 years, but like you're probably making a pretty good dent because all of that you're paying is going into your mortgage. Now, the other side of that is you have the ability to make changes to your mortgage. Like you can re-amortize, which I think is what you're going to see a lot of people do. And what I'm seeing people do is push that mortgage out a little bit longer, make that payment a little bit smaller than it needs to be because you can't afford to make that extra, let's say $500, $1,000 payment because your rate went up, right? So we can stretch that mortgage back out. That'll keep your payment a bit lower and it'll help you manage your cash flow in the short term. So I think really what it's doing is it's causing brokers to be a little bit more creative and offer different solutions. You're starting to see some lenders come up with even longer term amortizations. Now, this isn't in the what we would call like the prime or the A lending space, so your big banks, but like in the alternative space, yes, maybe you're paying a little bit of a higher rate, but if you can push that mortgage out a little bit further, again, it might save you some more money in the long run. And it can help you qualify too, because I mean, qualification's the other concern, right? So do I think that we're going to see some challenges? Yeah, I do, especially if we continue to see unemployment rate go up. There's a lot of people thinking we're going to see a recession in Canada. I mean, you could argue that we're already kind of in a minor recession. So I could see things getting a little bit uglier in the next year, but I think you're right. We haven't really seen anything significant happen, and it has seemed a little bit sensationalized because everyone's like, oh my gosh, I think it was something like more than 50% of mortgages were coming up for renewal in the next few years, if not higher than that. I think it was actually close to like 80% over the course of 3 years. And there's a lot of concern about that. But I think people have been getting around it for now, but I don't know if that's going to continue into the next year once we start to see a lot of people really coming off those 1% to 2% mortgages. Like, are we going to see those people still be able to manage? I don't know.
One thing I wonder about anecdotally too is how much of it is necessarily the mortgage payment going up and how much of it is like just the price of everything else going up.
Yeah.
So it's, yeah, okay, your mortgage goes up by $400 or $500 a month. That's, don't get me wrong, that's a lot of money, but your mortgage going up by $400 or $500, as well as every time you go to the grocery store, it costs you $50 to $100 to pick up stuff for dinner. I think that's also kind of an adjustment for people, putting all of that into the same bin, if you know what I mean. So yeah, I think that's really interesting and something to watch over the next, I'd say 6 months, a year, and then even longer than that.
Yeah, I got two quick questions. One, remind me, when you re-amortize, do you have to get an appraisal again or no?
It depends. That's a really good question. It depends on the lender. So here I'll share with you guys a little bit of a caveat right now that we're seeing. So assessed values, as you guys know, are not always a good indicator of actual value. And right now we're actually seeing it be the opposite of how it was before. Before we were seeing assessed values come in lower than what you could sell for. Now we're seeing assessed values higher than what you can sell for. So what I've learned now in the recently is if it doesn't make a big difference, you can basically, when you're submitting a mortgage application, you can say that the home's actually worth less than it is, because what's going to happen is if they go and they run their automatic valuation model, which is essentially just a way to skip the appraisal. It's a computer program. Yeah, it's a computer program that basically looks up data and it determines, okay, is this home worth what you're telling me it's worth? And if it comes back and it says no, it's going to trigger an appraisal. Now, a client's got to pay for the appraisal, right? That's a few $100s. So if you're going off the assessed value, good chance the value is not going to come back at the assessed value. It's going to trigger an appraisal, and now the client's got to pay out of pocket for that appraisal. So it's in the client's best interest, if it works in terms of, if the numbers work, let's just keep it simple, to actually value that home a little bit less so that hopefully you can skip out on an appraisal. So to answer your question, Alex, really what it comes down to is, what is the home worth compared to other homes? And if the model can accurately determine, okay, that seems like a reasonable number, great, you won't have to get an appraisal. But if it's not, then it's going to trigger an appraisal. Yeah, I mean, that's kind of the answer to that question.
Yeah,
I'm just stunned that you said that, assessed value isn't the, gold standard of what a place is worth.
No, it's the, how do we get more property taxes out of the homeowner value? That's what it is.
That is sarcasm, guys, from a realtor. We talk about this all the time. Oh, but my assessment is X. And it's like, if it was as simple as, just listing everything for assessed value, you would not need us. Anyway, Alex, your other question.
Yeah. So the other one, and I've tried to look into this before, and I don't know if the data is just not very apparent, or it's hard to find, or because there's so many different lenders. But like, what I was trying to figure out was kind of the average size of a mortgage, right? Because some of the stats I've seen, and don't quote me on this, but I think, and especially in like BC, there's a large number of people who actually don't have a mortgage, number one, in terms of home ownership. Obviously, we can pull the mortgage numbers themselves, but from what I found, I thought, and I think this might have been across Canada, the average size was like $400,000. Because it's not like every single person has this maxed out mortgage, right? Like a lot of people, if they're, I mean, depending on age and time that they've owned the home and so many different factors, but they might have already paid down half their mortgage. And so that's going to be a significantly smaller number than, I don't know, someone maybe like ourselves who haven't been in the market for as long, right? So that's what I've always tried to like look into and kind of break down to say, okay, well, yes, somebody with $1 million mortgage or something that's extremely high, that's going to be significant. But if you only have, I don't know, a $300,000 mortgage left, that's a much smaller number and like shouldn't really impact you as much. I know everyone has different levels of income and whatnot, but if they were able to get into this home, I would assume they'd be able to pay it. So anyways, I was just curious if you happen to know any of those numbers, or maybe you can just validate that they're difficult to kind of come across.
Yeah, I would say that they are difficult. Speaking to some colleagues that have been in the industry longer than I have, that number you gave is the number that gets thrown around a lot. Like 400 to 450 is kind of the average. And I mean, we typically talk about it more in like when we're planning for what, like honestly, from like what we're planning in terms of like making money. We're like, okay, if we can assume that every mortgage is approximately this much, how many mortgages do I need to do in order to make X amount of money? And I'm not saying that because I'm chasing money. I'm just saying that because that's what people do. And I'm sure you guys as realtors do the same. It's like, well, I got to do
That's just
this.
business math.
Yeah, I got to do this many deals if I want to make this much money. And like, and that's a number that gets used a lot. And I think it gets used because it's a fairly good representation of what you can expect. And because as brokers, we're not only originating new mortgages, we're doing mortgage renewals, we're doing all types of different mortgages, right? So I think that number is a pretty reasonable estimate. That's what I'm trying to say. Now, I'd love to know exactly what that number is. Plus, it's going to change province by province, city by city, right? I mean, obviously, there's going to be some differences there. But I think what's interesting that you brought up, Alex, is that number about how many people don't have a mortgage. And I think it's close to 50%, if not even higher. Like, there's a large portion of homeowners that don't have a mortgage. Now, there's also a lot of people there's a lot of people in the age demographic, I think, like kind of like our grandparents' age. So like kind of the like 70 to 70s, 80s age, that they own homes. Most of them don't have a mortgage because they've had their home long enough that they would have paid off their mortgage. And I mean, they carry a lot of wealth. I think we know that. But yeah, I think that's interesting because it's obviously generations are going to move on and people pass away. So that data is going to change probably the next 10 years as more people start to buy homes and as some of those other people start to sell their homes or unfortunately aren't with us anymore. But yeah, I think that's a pretty good estimate. I would say it's about that 400 mark.
And just to kind of, I think the issue that I'm getting at is like, there's always these blanket statements.
Yeah.
But like, that's why I always want to dig a little bit deeper. And then like, hey, there's 100%, I'm not disagreeing, there's going to be people in trouble, right? But like,
yeah,
what overall percentage? It's even like when they talk about foreclosures or court ordered sales here. And I can say, you know, the numbers are up 500%. But if there's only one last month and there's 5 this month and there's, you know, 500 sales and that, what is that, like 0.1% of total sales? Like it's very easy to kind of, you know, skew the numbers there. So
there's you talking about relative and absolute again, right?
There we go. That's how we bring it back. Bring it around.
Yeah, exactly. So, I mean, last quick stat here, because I'll just wrap this up and then we can chat about anything else. So days on market, detached and condos are taking over 5.5 weeks on average. Townhomes are about 5 weeks. Not a lot of change there. I mean, it's going to take some time. Now, as Austin kind of pointed out, there's pockets where things are going to do better. And I mean, in general, there's just places that are going to sell quicker than others. Like we all know that this is an average. It's not necessarily the best representation of what's happening in terms of what you're trying to sell. But I think it gives a good generalization of things are taking a bit longer to sell. Patience is something you should come into any transaction with because there's no guarantee that you're going to sell right away. And then from my side, what I would say is that's why it's even more valuable to have a realtor because they're the ones that can set those expectations for you up front and make sure that you understand this could happen, this could happen. It's probably going to fall somewhere in between. And just kind of setting that standard up front so that there's no surprises.
Yeah, I don't want to get off on a tangent here. I know we're already running long, but it's an interesting conversation because I think a lot of us, you know, when a seller wants to maybe list a little bit higher, the conversation usually is okay, but at the 2-week mark, maybe we should, I mean, that's when we should make a change if we haven't got offers or however your process looks. And now that the days on market has gotten longer, it's like, should we be waiting a longer period of time in order to make that change? Or are you actually just like digging yourself a bigger hole? Because in a, we'll call it a downtrending market, which I mean, realistically, that's what it is right now. You realistically want to be a little bit ahead of it versus trying to play catch up the whole time. So
Do you want to set the benchmark? Like, do you want to be in charge of your own destiny, or do you want to, give it a few weeks and then, might have to adjust more? Like, I just had a conversation with some people, same idea. And it's like, look, if, I think right now you're worth around, let's say 1.7. Well, do you think we could do like 1725 or 175? And it's like, you could, but also understand if we do that, in 2 weeks, when we say, or 3 weeks, or whenever we find out that maybe that number doesn't work, just don't be surprised if I'm now saying, well, now that, the data says that we need to be below 1.7, right? So do you want to chase looking for that extra little bit of money? Or maybe it's just about the conversation of being like, look, if you want to move, this is what the math looks like. This is where you need to be. How much do you want to bet? Sarah, I believe it's, who was it? Sarah Pickering in our office at one of our roundtables. One of the ways that she kind of, the language that she used was like, if you list at 1.7, I feel like there's a 90% chance that you're going to sell at that number. If you list at 1.75, there's a 60% chance that you'd sell if you list at that number, as opposed to if you list at 1.8, there's like a 15% chance that you're going to sell if you list at that number. You got to play the probability and the odds here. How confident do you feel? And ultimately it's, we're here to give people our professional opinion and our advice, but a lot of times clients, they want to make the decision for themselves, if that makes sense.
no, exactly.
Yeah, I think that's really well said. That's all we have for stats today. Do you guys want to add anything else before we wrap it up, or are you guys okay?
That's nothing else I can really think of specifically.
Okay, awesome. All right.
Yeah, I think one thing that I'll maybe just end with is, we're talking about some of the challenges in the market. Cole and Alex had alluded to it. There are definitely some opportunities in the market as well, whether that's upsizing or getting into the market. Like, there are some really great opportunities for people to be maneuvering within this market. So we don't want to sound all doom and gloom by any means, but if you guys ever have any questions, don't hesitate to reach out to any of us. We'd be happy to help, or grab a coffee, or just answer any of your questions.
Awesome. Thanks a lot, Austin.
Thanks for having me.
Yeah, thanks, Alex. Yeah, you guys have a great rest of your day.
Take care, guys.